Good evening. Welcome to the ShadowTrader Video Weekly for Sunday, September 28th, 2018. First things first, a little bit of house cleaning. I've been kind of alluding to this for a while, that the pre-market writings will not be free after Monday. Starting Monday morning, this is going to $20 a month. So if you're on our website, if you do like reading this every day, and you still want to stay on, you would just be under the Futures Market Profile tab and select Peter's Pre-Market Perspective right here, which will take you to here. And you'll see that if you are not yet a current subscriber, you'll get this message, which you'll just click Pre-Market Perspective, and it'll take you right to here. Okay, you can also get to there in the overview, right at the top of the Futures Market Profile, and just scroll down here. These Dalton webinars, or some, intensives rather, are starting on October 2nd. But anyway, the pre-market perspective is here. And as a reminder, those of you who are in the options advisories, either weeklies or time spreads, doesn't matter. Both of those will include the pre-market perspective for free. I'm not charging extra to any of my people who are signed up for weekly options advisory with me or with time spreads advisory with my colleague Scott Gillum. It is included. So you may want to consider that. That's a pretty good deal to get both products for one. All right, let's get over to the markets if we could. We had an FOMC meeting this week on Wednesday, and the rate hike was expected. There was like a 98% chance it was going to happen. We knew that. We're probably going to get another one in December. What was interesting was the lack of market movement once they announced, but then there was a little bit of craziness just at the very end of the day when Jerome Powell had his very own personal irrational exuberance moment and said something to the effect of that, some asset prices are a little high. And of course, the market didn't like that, sold off a little bit. That was on Wednesday. But of course, if you notice, since then, we have just kind of rallied a little bit higher and moved around, and we never really breached this 20 MA. So really, the market really kind of threw a fit just for all of about 30 minutes total, and not a heck of a lot happened. So we kind of find ourselves not too far away from where we were last week. That's why I titled this video Stuck in the Mud. I'm still concerned that there's still a huge distance between where we are and the uptrend. We have also now touched the top of the channel here twice in relatively close proximity, but that's okay. That happened here, and we still made a higher high. Generally, I'm of the opinion that when you have these very shallow pullbacks, that the market does want to lead to a bit higher. Like right now, you see the market, for instance, look at the amount of time that we spent, for instance, here, and it was just this kind of slow dribble down. And when I get to the profile, it'll illustrate what this looks like much better. And it seems like we're in the same type of slow dribble downwards. All right. And before I get to the profile and talk about some other things, I'll just mention that other indices really look the same. NDX, I think, is really kind of stuck here, where I find it interesting that we broke out of this more or less balance area. Now we've got this tiny balance here. As I was saying in the S&P, when I used the phrase "what worries me," as I was saying, look, the SPX is a little bit high off the bottom of the channel, and it hasn't moved down there in a while. Well, the NDX also has a warning sign flashing, and that warning sign would be the ascending wedge, which is this pattern here. This is a pretty powerful bearish pattern, and it would be nice if the NASDAQ stocks had one more push and kind of put themselves right up into the top of that channel or into the corner of that wedge around the 7,800. So be looking for that. That could easily happen before the end of the year. And personally, I think that kind of sets up a short point. Generally, these bearish wedges kind of moving up like that are not a good thing for the market. All right. Let's take a quick look at market profile, and as I was saying before, I think this really illustrates the fact that we haven't gone anywhere, that even though prices seem to be moving lower, remember, you want to focus on where value is. So look at what happened this entire week. These two value areas are identical. Not only are the value areas identical, but the entire range. And this is the Fed day, and I was pointing this out to the readers of the pre-market perspective earlier this week, that notice that when the Fed day occurred, there was definitely a lot of price action here and here, but there's no value there. And where did the value develop on Wednesday? Well, it developed in the same exact place as Monday and Tuesday, right? There's Monday, there's Tuesday, and there's there. So even though the value area mathematically, according to how much volume is traded at each level, is calculated and took the profile all the way to, or the value area rather, from here to here, If you look at how much time was spent, where's the real width? It's right here. And then what happens Thursday? Where was the greatest amount of time and volume spent, more or less? In here. It's a little bit smaller than that, but right in here. So notice that it's the same. And then here we have a little bit of value just overlapping to the downside on Friday. But at the same time, notice the point of control, relatively squat profile, kind of wide. That tells you that the market's in balance. When the profile is wide, market is balancing. And look at where the point of control was in relation to the prior day, Thursday and Friday. The fairest price to do business, as we call it, which is where the greatest amount of futures contracts traded, and usually the greatest amount of time, which is the widest portion of the profile, it was exactly the same. So that tells you that even though there were numerous what we call look above and fails and look below and fails in this market, they really didn't change value. All right, and this is also noteworthy that the balance seems to be getting somewhat tighter, because when you have a look above and fail, like for instance, this is a 2-day balance, and on Wednesday on the FOMC, you look above, you come back into range, you fail, and the target is always to the opposite end of balance. Now, the reason we went a little bit lower is that we needed to clear this virgin point of control here. We had a VPOC here that needed to get taken out, so prices went a little bit lower. But what's interesting about it is when we had a spike form at the end of the day. That means that spike rules are in play. Spike rules essentially come into play when you have a tail of single prints on the last half hour of trade. And the reason you call those spike rules is because you need to look at the next day's action to see if that spike is accepted or rejected. And interestingly enough, you can look at this very easily and just see very clearly that it obviously was not accepted. It was accepted here in an overnight range, but that doesn't count. Here you had just a little bit of value inside of the spike, and then look here, the value is all kind of higher. Again, it's a little bit inside of the spike, but really I don't think people are accepting the late day FOMC prices, and we never went below that area. Okay, now what key level do you need to look at for next week? This is important. I marked it off here as called as 3x bottom, and I did that for a reason, obviously, because it's 1 low, 2 lows, and 3 lows. Now, 2 of these sessions are overnight sessions, and only 1 of those sessions is an RTH session, which stands for regular trading hours. And I do understand that. But in the realm of the futures market, these overnight sessions are important, and the market does key off of it. It's no surprise that here, between Thursday and Friday, you had a low put in right here, just a couple ticks above this double bottom. That's not a coincidence. This tells you that traders are buying this level. Now, important to remember, what kind of traders are they? They're short-term traders, and they're relatively weak hands. Remember, the weaker hands form the weak lows, which bottom at either prior lows or nuanced profile references. So that means like when you have a low that is right at a value area low, or right at a point of control, or right to half back, that midpoint of the range, those are called weak lows. A poor low is a low that has no excess on the bottom, where it just has kind of a flat, rounded bottom on the profile, and there aren't any single prints on the bottom. So just keep that in mind. There's a difference between a poor low and a weak low. And these overnight lows are weak, and when they're weak, that means that they have the propensity to be toppled over, because the buyers that stepped in here were very nuanced, very calculated, very day trader-ish kind of, or in this case we should call them night traders, right? Because these are overnight sessions, and they're picking up bargains right at those prior lows, whereas the larger traders, they don't really care about that. They're looking for just the meat of the move. So coming into next week's session, I want you guys to pay very close attention to this 29.0750 area, give or take a couple of ticks. That's going to be key. If we go a little bit lower, we probably move well under the 2900. And if we look at the technical picture, right, we got to switch over to the SPX. If we were to breach that area, what's going to happen is it's going to put this 20 MA into play, and that will actually be very important, because notice that as of a while now, we haven't breached the 20, correct? We've rode above here, then we had a pullback to the 20 that held. This is a look below the 20 and fail. It was just 1 bar, and then you rallied right back. Look at this support on the 20, and then you have the support on the 20 here. So this coming week, also the start of a new month, is going to be very key, and that is the key level that you want to be watching, which is approximately 2900 in the SPX cash. and also that key futures level, which I talked about earlier, which is obviously a little bit higher because we just flipped over to the new contract, so the cash is cheaper than the futures currently, and that's at around 29.0750. All right, and I'm going to leave it there. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I wish you good trading and good night.